Hey traders, Stephen Kowitzel here with the TradersPlan.com, working on my weekly blog post. And today I want to talk about how to trade the VIX, or how you can utilize the VIX to make trading decisions. And I think it's a very important topic to talk about right now, because I believe, we're entering the real summer months. We could potentially be going into corrective mode. The VIX could be spiking. So I really wanted to walk you through what is possible and what levels you need to pay attention to when it comes to the VIX. Okay, so stay tuned. So what I have right here in front of me, what you're looking at is you're looking at the VIX, the volatility index. And if you're not familiar with that, it's really just the fear gauge. It's a gauge that takes all the represents a percentage of the S&P put options. So people are betting against the market, okay? So it's the fear gauge. So as the VIX rises, that means people are more fearful in the market. And as the VIX falls, it means all is good, right? So the level I really want you to pay attention to, and this isn't something I look at every day, but I look at it once a week, is the VIX, the volatility index, is this 20 level. Now I want to highlight this 20 level for a lot of reasons. So if the VIX is, right now it's really at a historical low, right? It came all the way down to 8, right? So we've been in a big bull market. You can see the market has been rising. The VIX has been falling. There is a inverse effect. Now this is the S&P 500 in this pain down here. So now it looks like we could be in a little corrective mode while the VIX is rising. So they typically have an inverse relationship, and you can see that over here in the side panel. Okay. So, when the VIX is between 17 and 10 or 17 and 12, that doesn't really concern me, okay? That doesn't really scare me or fear me. The market is going to have, sharp pullbacks, and especially in a bull market, the sharp pullbacks will eventually resume the uptrend, right? So when it starts to click above 17, I start to take a little bit more notice, but when it starts to initially spike above 20, that's where you have my attention, okay? And why the 20 level is so important, at least just from what I've seen in the last several years, I'm about to show you. I'm about to show you the relationship. So a lot of times when you get this volume spike, right? You get this spike in the VIX above 20, a lot of people think that's a buying opportunity. It's a fear gauge. Warren Buffett says buy when others, or sell when others are greedy and buy when others are fearful. Well, that's not necessarily the case as far as the VIX goes if you're looking for short-term swing opportunities. So I want to look at all these examples. All these vertical lines are when the VIX initially, that means for the first time, popped above 20. Sometimes in bear markets, they'll stay above 20. But I want to look at real-life examples of what happened going back to 2014 of when the VIX initially spiked above 20, okay? So it spiked above 20. And then you go down here. Now, if you would have bought that day, you would have been pretty close to the bottom, but the market would have corrected about another 3 to 4%, okay? So if you're looking to buy when it goes above 20, sometimes that's not the best strategy because what I'm about to show you is a lot of times that first spike above 20 is really just the beginning, and you need to be very careful because sometimes what will happen is the market will spike. The VIX will spike to 20, the market will put in a short-term bottom, and then it will, bounce for a couple of days and then just roll over. And that's what I'm going to show you. So you have that VIX spike and the market continue to go down. So if you would have bought, an S&P 500 ETF, you wouldn't have really been hurt that bad. You might have been stopped out. If you would have bought a leverage ETF, you probably would have been crushed right here, right? You probably would have been down 10%. So let's look at the next example, that initial spike above 20, and you can see that the market continued to go down for, it looks like maybe a couple weeks. And same thing over here. It looks like it continued to go down a couple weeks. Now here's another thing. This was in July of 2015. It spiked just barely above 20, but look what happened. It put in a short-term low. It tried to break to all-time highs. It didn't. It's slightly below, and then just completely rolled over. So from this point, the time that the VIX breached 20, there was a 9% drop in the S&P 500 to this swing low, okay? So if you would have bought that thinking that was a bottom, now if it was a short-term bottom, you could have made a nice little swing trade, but if you were thinking you were going to ride off into the sunset, you probably would have been stopped out. And if you'd own an individual stock, you would have really been crushed, okay? Because individual stocks are going to be down 2-3 times what the market is, okay? So let's look at the next example. We have November 2015, popped above 20, and you can see it was an immediately short-term bottom right here, came back, tried to take out the new highs, couldn't, and it just completely rolled over, corrected 11% from the time the VIX initially breached 20. Let's look at this example, right? The VIX hit 20, it tried to come back, couldn't break the highs, and then just cracked. Took another leg down, 5% drop from this point right here. Now from the top, it's probably more like a 7-8% drop, but from this point, it was just a 5% drop. Here's another example. You have a short-term bottom, and you can see that it couldn't break the highs, and then it just rolled over. So you have a 3% correction, but probably more like a 5 from here to here. And then on this try, you probably only had a 1 to 2% correction, and it really was the bottom, okay? So out of 1, 2, 3, 4, 5, 6, 7 examples of the VIX breaching 20, only one of them I would say truly was a nice intermediate bottom, and then you had a nice rally. So when the market sells off quickly and breaches that 20 level, it's okay for the market to be oversold, but when it breaches that 20 level, I'd be careful. So I just kind of want to recap. When it breaches 20, I would give it a little bit of room. I would let it see if the market can turn around and break that high of where the market was when it reached that 20 level. Because you can see it did it right here. It broke the high, but then it just, if you remember the choppiness of 2015, it was brutal because the market was topping. Now look right here. If you would have bought this breach, it never broke the high. You might have been better off to buy the high, but it didn't, and then it just rolled over. Same thing with here, never broke the high, rolled over. Same thing with here, it never broke the high, it never broke the high. This was the winner. So if I can really teach you anything, here is a couple of simple rules that you can abide by. One, it's safe to say that based on these 7 most recent examples, that initial crack of the 20 in the VIX is not the exact bottom, okay? That is very safe to say. At the very least, based on these previous examples, you're going to go down a few points. If you're looking for a short-term swing trade, right, I would caution to using leverage. Maybe you buy a Russell 2000 or QQQ and you take a quick 3% swing trade. And if it starts to roll over against you, why don't you just use that 20-day moving average? So if the market spikes and then pops back above the 20-day, then you can buy it. And then if it's riding, then all of a sudden cracks, that's your exit, is the 20-day moving average. So just some simple rules to put in place. You're looking for a quick swing trade. If the swing trade starts to work against you, sell when it breaks the 20-day moving average. Simple as that. Also, so right here you would have had a swing trade, but when it can't break to all-time highs, you need to take quick profits because you probably would have been out right around here for a quick swing trade. You probably would have been out, if you decided to buy this, you probably would have been out somewhere up here. So it would have been a good swing trade. But just my point is, don't back up the truck when the VIX hits the 20. Typically, it is that first yellow sign, that caution. So simple rules. Just be very cautious and wait. A lot of times, if you're conservative like me, wait to see if the market can break out to that new high, because based on previous examples, if it can't, it can just completely roll over and your timing can be off. So wait till it breaks that high. Could be a very conservative rule, but if you want to swing trade it, I wouldn't recommend using leverage. Use a QQQ, use a IJR or small caps, and just buy it. And then as soon as it breaks that 20-day moving average, then you can sell it, or the 5-day, or just whatever you want to use. So pay attention to this 20 level. It's very important. I hope this was helpful. Let me know if you have any questions.